Thank you very much. It's Krejcik. We picked a really easy firm name. Todd Eilers is the other partner. My name's Adam Krejcik, and so Eilers and Krejcik Gaming. It just rings off. It rings off the tongue. But anyway, it's a pleasure to be here at Pocket Gamer. We're a U.S. company. I'm specifically from California, and we also have an office in Las Vegas. I'll just give a quick intro so you know just a little bit about us before we talk about the M&A market. We're an independent research, boutique research firm. We produce market research, intelligence, competitive landscape analysis. We look at KPIs. We incorporate data, a lot of data, but then importantly, we provide a lot of qualitative analysis to that data. So our reports, they're subscription-based, it's paid research, and we work with a lot of companies in the gaming industry, both traditional casino, real money gaming, as well as mobile free-to-play. I head up the mobile, the free-to-play division at the firm. And beyond the market research reports that we produce, we also do some consulting and advisory. If you're interested in a copy of this presentation, we have a booth here. Please leave your business card, and I can send you a digital copy of the report. We also have samples of some of the other market research reports that we produce. So moving on, mobile gaming M&A. First, obligatory slide here on the market size. These estimates will vary a little bit, but most people, ourselves included, have got the market. This is mobile gaming only at close to $70 billion. We're at $68.5 billion for 2019. This is iOS and Google Play Store revenues worldwide. And then we've also broken it out recently between IAP, in-app purchasing revenues, and in-app advertising revenues. So you can see IAP still drives the majority of the revenues, but in-app advertising has been growing and at a faster rate. Overall, the market we project has grown about 34% calendarized growth rate from 2013 to 2019. And the reason this is important with respects to the mobile gaming market is basically you've seen deal volume and the size of the transactions correlate pretty nicely with this chart. So if we were to overlay the number of M&A transactions in mobile gaming and the average deal size, it would look similar. Not exactly, but generally speaking, the M&A market is supported by a growing mobile game market size, which again shouldn't be a major surprise to anyone. So looking at the M&A market, the state of M&A, so this is kind of the last 2 years. There's a couple of important components here. Number one, strategic M&A. This is companies acquiring other companies. Really the theme over the past 2 years is there hasn't been any mega transactions. By mega transactions, we define that as over $1 billion in deal size. Rather, what you've had is a number of what we would say smaller cross-horizontal type acquisitions, mostly in the $100 to $500 million range. And I would say the four most active companies and relevant ones are listed here, starting with Playtika, well-known Israeli social casino company. They've been on an acquisition spree, mostly acquiring studios with games outside of casino. They've acquired Super Treat, which produced Solitaire, Wooga, and then most recently Seriously Games. So they've been very aggressive on the M&A side, looking at expanding their business into casual outside of core casino. Another big player recently has been Zynga. If you were in this track earlier, you heard from some of their recent acquirers, Small Giant and Graham Games, but Zynga's been very active, again, on the M&A front. Next up, AppLovin. This might come as a surprise to some people. AppLovin's a major ad tech company, but increasingly they're also a major player in the mobile gaming space. I think it's well known that they own Lion Studios, the hyper-casual division. Perhaps less known is they also own Firecraft Studios, Studios. That's the studio behind Matchington Mansion. And then they've also invested in some well-known companies like Belka Games and People Fund. People Fund's the developers behind Wordscapes. Last but not least, you have Tencent, the largest gaming company in the world. They're constantly in the market pursuing transactions. Two of their most recent ones, Ilion, a developer of Bubble Shooter out of Israel, and SharkMob. So those are some of the notable deals from the strategic side. Importantly, you also have a pretty robust private equity and fundraising market. And the reason we also include this on the lower level is you really need all of these players, all of these markets in the ecosystem to be working to have a really vibrant M&A market. And that's exactly what you have right now. You have healthy fundraising from some well-known game VC funds like Makers and Benchmark. And then perhaps less known is private equity is also increasingly taking stakes in some game companies. Blackstone acquired a social casino company called Merca, and the ad tech rewarded video company Vungle last year. KKR has major investments in AppLovin and Epic, and then CVC, a well-known European PE firm, made a large investment in IronSource last year as well. So again, the theme here is the backdrop is a very robust, vibrant M&A market supported by both strategic as well as private equity and VC fundraising. So despite the lack of kind of headline, transformative, $1 billion plus deals, I would argue the M&A market is very, very healthy right now. And so are the good times coming to an end? We don't think so. And so I've kind of laid out 5 themes on why we think you're going to continue to see a very healthy, vibrant mobile gaming M&A market. Number 1, increasing barriers to entry in the form of rising UA costs and challenges around discoverability. So basically, it shouldn't be a surprise if you're a developer or publisher. It's increasingly expensive to get your game out in the market, to get discovered, and this is arguably the biggest barrier to entry costs, and it's very difficult for smaller studios to scale. And so again, this is a favor and a tailwind for M&A. Point number 2, the mobile gaming ecosystem is structured in a way that provides outside returns for companies at scale. Look, economies of scale exist in every business, but we would argue that the way the App Store system is set up, the power of getting featured on Apple, on Google, your relationships with the various ad networks, it's incredibly powerful to have scale in mobile gaming, and I would say it's even more so than just about any other internet service-based business, where again it really favors those larger companies. So again, that's another theme to why we think you'll continue to see M&A. Point number 3, games as a service, live entertainment platforms. This is a theme you've probably heard before, but games today. If you heard Supercell earlier, look, their games have been in the market, top grossing games for 10 plus years, and they think they'll still be, people will be playing them for another 10 years. So games are no longer hit driven. They truly are a live entertainment service. And what this means is a much more predictable revenue stream, and a more predictable revenue stream is a lot more valuable to investors and companies. And so this business as a whole, we would argue, is just becoming much more valuable as we move forward. Point number 4, and this might be a little controversial, but we think innovation is largely found at smaller and independent studios. The incentivization model, the payout structures really favor smaller studios, developers to take risks, and larger companies to basically follow the status quo. And there's obviously it won't always be the case, but companies like Small Giant with Empires and Puzzles, Moon Active with Coinmaster, these are smaller companies taking risks, trying to disrupt the ecosystem and having very, very positive outcomes and being rewarded for that. And we think this is largely going to hold, where the smaller companies is typically where the innovation is found, and then you'll always have this demand from larger companies. Finally, point number 5, last but not least, public equity markets really have not been that kind to mobile gaming. So in most instances, if you're a mobile game company, a mobile studio, the most likely exit is going to be strategic M&A. Very few companies have had success going public. That could change, but again, we think strategic M&A certainly has been the most likely outcome and will continue in the near term. This is a slide. We do a lot of work in social casino market, and so I just wanted to provide some context here. This is I like to joke, a banker's wet dream, but between 2011 and 2017, this is a good example of what can occur in a high-growth genre where there's significant third-party interest in companies needing to scale. You saw almost $10 billion worth of transactions just in one very specific sector. I'm not sure if this will be repeatable, but again, it's an interesting example of what can happen in one of these M&A type waves and surges. Lots of numbers here, but the takeaway, this is the comps. This is the average multipliers for transactions, for a lot of notable mobile gaming transactions over the last 10 years. The key numbers to note here and questions that come up a lot is what's my company valued? What's the business worth? A very easy back of the envelope way to do that is to look at what the average multipliers have been. And basically, on a sales basis, on gross revenues, 2.5 times trailing has been the average multiplier, and this is the upfront component only. If you look at it on an EBITDA basis, it's been 8.8 times trailing 12 months EBITDA. If we add in the total deal value, if we add in contingency payments and earnouts, that goes higher to about 10.5 times. Again, they will skew and will vary, but a very easy kind of back of the envelope valuation methodology is to look at comps. And interestingly, public companies are trading at much higher multiples. And the reason this is important is this makes the public companies acquiring privates can be pretty accretive. Granted, there's not many pure play mobile gaming companies on this list, but nonetheless, the public markets, public video game and digital game companies are still trading at pretty nice multiples: 17 times forward EBITDA, 23 times trailing. A quick slide here on Zynga again, and we bring them up. As I noted earlier in my lecture, they've been among the more active on the strategic M&A front and really have had some good success. I think historically, Zynga has gone through some tumultuous times. They've had some very bad acquisitions, but credit where credit is due. And the last 2 deals that they've done, acquiring Gram Games, maker of Merge Dragons in May 2018, and then Empires and Puzzles later that year, have really been home runs. There's lots of ways to measure the success. One easy way, just looking at the share price, it's increased almost 2-fold since they've announced those deals. And I will tell you that Empires and Puzzles and Merge Dragons are now their 2 biggest games in their entire portfolio. So 2 very important deals for Zynga's, and 2 that have been very well received by the market. Okay, final slide for me here. I mentioned that we think strategic M&A is going to be kind of a continue. But this slide, I'm sorry, there's a lot of text on here. It's from a larger report that we did. 2020 and really 2020 to over the next couple of years, there could be a number of IPOs, and I think that would be good for the markets as well, because there really isn't that many pure play mobile gaming companies. And we've kind of put our likelihood, again, this isn't based on any insight, this is our own kind of analysis, but top of that list is AppLovin. We think they are absolutely going to go public sometime here in the next year or two. Again, it's a natural exit for KKR. They've made some management changes. They've They've been acquiring studios. Revenue expected to exceed $1 billion, so they're certainly at some nice scale. And they were last valued at $2 billion. So they're likely looking at trying to IPO somewhere in that $3 to $4 billion range. And so that's our highest confidence in terms of companies on here that could go public next year. Playtika has been in the news again. Massive social casino company. They're owned by a Chinese conglomerate right now. Last acquired in 2016 for $4.4 billion. That company they've grown significantly since then, both organically and through strategic M&A. If we had to guess, you'd likely be looking at an IPO in the $8 to $10 billion range. So they would be a massive, one of the biggest game companies out there. Two more here. Again, our confidence in terms of when they could IPO is a little bit lowered here, but Jam City and Scopely, both Los Angeles-based companies, have raised significant money from investors, and so we believe at some point, if it's not strategic M&A, both of those companies could look to go public. They certainly have the infrastructure in place to do that. And then last but not least, we also put Epic Games in here, but we don't think that's a near-term likelihood. So again, takeaways here, very robust, vibrant M&A market. There's been a lot of deals over the last few years. We think that is going to continue, and who knows, we might even get some more mobile gaming IPOs in the future as well. So thank you for listening. Happy to take questions.
Yes, I'm bringing the microphone to you. Just a second.
Oh, that was fast.
See?
I'll stand up. Hi. So you spoke about the likes of Zynga. What is their, or a company like them, what do you feel is their ultimate motivation for acquiring some of these studios? Do they feel that they can potentially make them earn that much more and therefore they're getting good value, or is it portfolio diversification? What is ultimately driving them to M&A?
Yeah, I mean, they think the combination of them is 1 + 1 = 3. I mean, that's always a cliche way to say it, but they think they can bring some value in terms of scale, and certainly they view these businesses as complementary to kind of their core business as well. And Zynga is a publicly traded company, and so they are working to get for their shareholders essentially, and trying to grow their revenues, earnings, and have a successful stock reaction as well.